What if I told you that one of America's biggest coal polluters just became the second largest nuclear fleet operator in the country? And what if I told you this same company is now powering the AI revolution while returning billions to shareholders? You probably know TXU Energy if you live in Texas. They're the #1 electricity provider in the state. But what you might not know is that their parent company, Vistra VST, on the New York Stock Exchange, just pulled off one of the most dramatic corporate transformations in modern energy history. We're talking about a company that was literally ranked as America's #1 greenhouse gas polluter as recently as 2024, yet somehow managed to acquire 4,000 megawatts of clean nuclear capacity in a single deal. This is the story of how a coal-heavy generator emerged from bankruptcy to become a $40 billion clean energy leader positioned perfectly for the AI boom. Buckle up. This transformation story will blow your mind. Vistra Corporation, VST, is a Fortune 500 integrated electricity company headquartered in Irving, Texas, with a current market cap hovering around $40 billion. But here's where it gets interesting. This company has roots stretching back 140 years to 1882, making it one of the oldest energy companies in America. Most people know Vistra through its retail brands. If you're in Texas, you've definitely heard of TXU Energy. They're the state's largest electricity retailer, serving more customers than any other provider. But Vistra also owns Dynegy, Ambit Energy, and now Energy Harbor, giving them a retail footprint across 20 states and the District of Columbia. Here's the scale that might surprise you. Vistra is now the largest competitive power generator in the United States, operating approximately 41,000 megawatts of capacity. That's enough electricity to power roughly 20 million homes. They serve around 5 million retail customers while operating everything from nuclear plants to massive battery storage facilities. But here's what makes this story absolutely fascinating. This company was literally born from the ashes of one of the biggest energy bankruptcies in history. The old TXU Corporation collapsed spectacularly in 2014 under $40 billion in debt from a disastrous leveraged buyout. What emerged was a completely reimagined company that would go on to execute one of the energy sector's most stunning turnarounds, and the transformation is far from over. To understand Vistra's incredible journey, we need to go back to 2007 and one of the worst-timed deals in corporate history. That's when private equity giants KKR and TPG bought TXU Corporation for $45 billion. Right at the peak of the leveraged buyout bubble and just before the financial crisis hit. The plan was simple: build 8 new coal plants across Texas and ride the energy boom. Instead, they rode it straight into bankruptcy court. By 2014, the company that was supposed to dominate Texas energy was drowning in debt and desperately trying to shed assets. But here's where the story gets interesting. When TXU's successor, Energy Future Holdings, finally collapsed in 2014, something remarkable happened. The company's retail business, TXU Energy, and generation business, Luminant, were spun out as a new entity called Vistra Energy, led by CEO Curt Morgan. This wasn't just a corporate restructuring. It was a complete strategic reimagining. The new Vistra had 2 massive advantages. First, they emerged from bankruptcy with a clean balance sheet and virtually no debt. Second, they inherited some genuinely valuable assets, including the Comanche Peak nuclear plant and TXU Energy's dominant retail position in Texas. But the real genius was in what they did next. Instead of trying to rebuild the old coal empire, Vistra's management made a bet that would define the company's future. They would transform from a coal-heavy generator into a diversified energy company focused on reliable, dispatchable power. This meant keeping their efficient natural gas plants, maintaining their nuclear assets, and here's the kicker: becoming one of the biggest players in battery energy storage. They built the Moss Landing battery in California, which became the world's largest battery storage facility at 400 megawatts. The integrated model was brilliant. Used TXU Energy's retail business to provide stable cash flow and customer relationships, while Luminant's generation assets could capitalize on Texas's volatile energy-only market. When electricity prices spike during high demand, which happens frequently in Texas, Vistra's plants print money. But the masterstroke was yet to come. In March 2024, Vistra completed a $3.4 billion acquisition that would completely change their profile. They bought Energy Harbor, adding 3 nuclear plants and approximately 4,000 megawatts of zero-carbon generation capacity. Suddenly, this former coal giant owned the second-largest competitive nuclear fleet in America. The numbers behind Vistra's transformation are genuinely staggering. In 2024, the company reported $2.8 billion in net income on revenues of $17.2 billion. That's a remarkable 16% net margin in a typically low-margin utility business. But here's what makes these results even more impressive. Their ongoing operations adjusted EBITDA hit $5.7 billion in 2024, beating their original guidance by $856 million. In the energy business, beating guidance by that margin is almost unheard of. The cash generation is equally impressive. Vistra produced $4.6 billion in operating cash flow in 2024, giving them enormous financial flexibility. They've used this cash machine to execute one of the most aggressive capital return programs in the utility sector. Since November 2021, Vistra has repurchased approximately $5.4 billion worth of stock, reducing their share count by roughly 30%. That's not a typo. They've bought back nearly one-third of their outstanding shares, while simultaneously paying dividends. Their balance sheet strength is remarkable for a company that emerged from bankruptcy less than a decade ago. With the Energy Harbor acquisition closed, Vistra now operates over 6,400 megawatts of nuclear capacity across both ERCOT and PJM markets, the two most profitable electricity markets in the country. The integration economics are compelling. Energy Harbor's nuclear plants generate predictable cash flows enhanced by the Inflation Reduction Act's nuclear production tax credits worth $25 per megawatt hour. Meanwhile, the retail customer acquisition gives Vistra additional pricing power and load growth opportunities. Perhaps most importantly, Vistra has hedged approximately 100% of their expected generation volumes for 2025 and about 90% for 2026. In volatile energy markets, this hedging strategy provides earnings predictability while maintaining upside exposure to power price spikes. The financial transformation is complete. Debt-free, cash-generative, and perfectly positioned for growth. The investment thesis for Vistra centers on three massive secular trends that are all accelerating simultaneously: the AI-driven data center boom, the ongoing clean energy transition, and Texas's explosive economic growth. Let's start with the AI story, because this is where Vistra's positioning becomes almost unfair. Data centers require massive amounts of reliable, 24/7 electricity, exactly what nuclear plants provide. Vistra is already in active discussions with major data center operators about expanding output at their nuclear facilities, particularly the Comanche Peak plant near Dallas. The beauty of nuclear-powered data centers is the economics. These facilities will pay premium prices for clean, reliable power, and they're willing to sign long-term contracts. Vistra is exploring co-location opportunities at multiple sites, which could dramatically boost their capacity, utilization, and profit margins. But the growth story extends far beyond Texas continues to experience explosive economic growth, with ERCOT forecasting 138 gigawatts of large loads by 2030, up from 87 gigawatts today. This includes data centers, but also semiconductor manufacturing, thanks to the CHIPS Act. Oil and gas electrification in the Permian Basin, and general industrial reshoring. Vistra is perfectly positioned to capture this growth. They're already planning to add up to 2,000 megawatts of new natural gas capacity in Texas, including 860 megawatts of advanced peaker plants specifically designed to support West Texas's growing energy needs. The nuclear angle provides another layer of opportunity. With the Energy Harbor acquisition, Vistra now has operating licenses extending into the 2040s and 2050s for their nuclear fleet. As carbon pricing becomes more prevalent and grid reliability becomes paramount, these zero-carbon assets become increasingly valuable. There's also significant optionality in their battery storage portfolio. Vistra operates the second-largest energy storage capacity in the country, at over 1,000 megawatts, as renewable penetration increases and grid balancing becomes more complex. These storage assets should command premium pricing. The final piece is their integrated model advantage. Unlike pure-play generators, Vistra can optimize across both generation and retail, capturing margin on both sides of the electricity value chain while hedging their market exposure. Every investment story has risks, and Vistra faces several worth considering. The most obvious is regulatory risk around their remaining coal assets. While the company has been systematically retiring older, inefficient plants, environmental regulations continue to tighten, potentially accelerating closure timelines and requiring additional compliance investments. Commodity price volatility remains a constant concern in the energy business. While Vistra hedges, aggressively unexpected swings in natural gas prices or electricity demand can impact margins. The Texas market's energy-only structure amplifies both upside and downside price movements. There's also execution risk around their growth initiatives. Integrating energy harbors operations, building new natural gas capacity, and developing data center partnerships all require flawless execution. Any delays or cost overruns could pressure returns. The nuclear fleet itself carries operational risks. These plants require significant ongoing maintenance capital, and any extended outages can materially impact earnings. Safety incidents, while rare, could trigger costly shutdowns and regulatory scrutiny. Finally, there's competition risk in their retail business. As Texas's electricity market continues to evolve, new entrants and pricing pressure could erode TXU Energy's market-leading position. However, most of these risks are manageable through Vistra's diversified asset base, strong balance sheet, and experienced management team. Vistra's transformation from bankrupt coal giant to clean energy, Powerhouse represents one of the most compelling turnaround stories in American business. This is a company that emerged from the ashes of corporate failure to become the largest competitive power generator in the country, all while returning billions to shareholders. The convergence of AI infrastructure demand, Texas growth, and the clean energy transition creates a perfect storm of opportunity for Vistra's unique asset base. With the second-largest nuclear fleet, massive battery storage capacity, and dominant retail position in America's fastest-growing energy market, they're positioned to capture value across multiple growth vectors. But remember, this isn't financial advice. Every investment carries risks, and the energy sector can be particularly volatile. Do your own research, consider your risk tolerance, and maybe start by understanding how these massive infrastructure plays fit into your portfolio. What do you think about Vistra's transformation story? Have you considered the energy sector's role in powering the AI revolution? Drop your thoughts in the comments below. And don't forget to subscribe for more deep dives into underappreciated S&P 500 companies that could be hiding in plain sight in your portfolio.